everyone, thanks for tuning into my channel today, All Things Accounting. Today we're going to be talking about another depreciation method called the declining balance method. So stay tuned and we will get through this together. Hard day of work at a construction business. So let's say, for example, another depreciation example would be depreciation under the declining balance method. If I use my truck for construction, I might be using it a lot over the beginning of its useful life. So if I'm using it a lot of it, then I might have to account for more depreciation at the beginning of its useful life. So there are certain benefits and disadvantages to it. We'll go through a numerical calculation on the whiteboard. So if you want to follow me, we'll get this thing done. So we're here in front of the whiteboard and we're going to go through a numerical example of the declining balance method for depreciation. So as I had alluded to earlier, let's say, for example, if I was using my pickup truck for construction purposes, I might be using it a lot more in the earlier life of the asset. Therefore, if I'm using it a lot more to generate income, I would have to expense a lot more to match up with the revenue for which it helps to generate. So some key things about this method is that this method calculates depreciation in the earlier life of the asset. So there's more depreciation recognized in the earlier life of the assets. So instead of using the initial cost of the pickup truck, let's say, for example, instead of using the initial cost and then subtracting the estimated salvage value like straight line would do, we're going to use the cost of it, but then use a certain percentage that we will establish in order to allocate depreciation. So over time, the depreciation will decrease. So as we say, at the earlier life of the asset, the depreciation expense on a per annum basis will be higher, but as the years go by, you'll see that it starts to go down lower and lower. So we'll run through a numerical example right now. Okay, so let's say that we have a new computer. So the cost of the computer is equal to $12,000. Now, let's say that we've established a depreciation rate of 25%. And the estimated salvage value, we're going to deem that as being $3,000. Therefore, based on this, the new computer less the estimated salvage value, the total depreciation that we will be recognizing throughout the entire estimated useful life of the vehicle is going to be 12,000 less 3,000. So that's going to yield $9,000 total depreciation over the years that we're going to have to recognize depreciation. If we were to set this up as a chart form, just for ease of calculation, book value, then there's depreciation, and then over here would be the total depreciation. So, first year, in year 1, the way we're going to calculate this, we'll take $12,000, which is the cost of the computer, and to calculate the depreciation, we'll take the $12,000 and we'll multiply by the 25%, and that would yield $3,000. So in this case, the total depreciation recognized so far is $3,000. In year 2, when we calculate the book value, it will be calculated as 12,000, I'll just denote 1,000 in K, just to save some space, minus the $3,000 here, okay? So that would give us $9,000. Now, based on this $9,000, we're going to calculate the depreciation on that, multiplied by 0.25, and that would yield $2,250. So, what is the total amount? It would be, total depreciation would be $3,000 in the first year plus the $2,250 in the second year. So that would give us $5,250 total so far for the second year. In year 3, so here we are going to calculate this as the book value of $9,000 minus the $2,250, and that will give us $6,750. So we're going to now use this $6,750 and apply our depreciation rate of 25% to calculate our depreciation cost, which is going to be $1,687. So, if we look at this, what is going to be our total cost for depreciation? Our total depreciation will be the sum of this amount here, which was cumulative at the end of year 2, add the new depreciation amount for year 3. So that would be giving us $69,37 total so far. In year 4, we're going to be calculating the book value is $6,750 here minus that depreciation, $1,687. That's going to give us $50.63. So this $50.63 for year 4, if we apply the depreciation rate, will be giving us $12.66. And now, again, the total depreciation will be the sum of the total at the end of year 3 plus the new one for year 4. So that will give us $82.03. The book value as $50.63 minus the $12.66 that we computed there, that's going to yield $37.97. Now, if we were to take this and calculate at a rate of 25%, $37.97 multiplied by 0.25, that would give us $949. But we will not be recognizing this on the books because remember that the total depreciation was originally the $12,000 minus the estimated salvage value of $3,000, and that's $9,000 that we said in total over the useful life. So that means that in order to get the up to $9,000, we can only recognize $797 from, so if we were to take 9,000 minus that would give us $797, because this plus that will give us the 9,000, which will balance out. Example of where this would be very relevant in terms of using the declining balance method is some technologically advanced equipment might be coming out every so often, every couple number of years. For example, maybe Apple iPhones always come out every couple of years or some, and a new version of it comes out. So in that case, you might be using it a lot more during the beginning life of the particular technological device or equipment. And so it would make sense to amortize or depreciate that faster. So I hope this tutorial helped you a bit, and please remember to subscribe to this channel. Click that like button and hit that bell notification icon so you're always up to date on the new tutorials that I'll be posting. Until next time, take care.